inflation continues to be the top concern for our clients and us as well, and I'm sure the investment committee too. Since we last met a few months ago, we've seen a few inflation readings and a pivot from the Federal Reserve, in addition to other global central banks surrounding their view and approach to combating those issues. But why don't we start with a quick recap of how we got there and high-level thoughts from you and the team?
Absolutely. Yeah, and Chris, as you mentioned, inflation really is, the top concern of the investment committee, not just during the last quarter, but really for the bulk of last year, and it continues to be a huge focus of ours, headed into this year. And undeniably, inflation's here, given that vast fiscal expansion that we saw over the course of 2020 and 2021, leading to the explosive growth that we've seen and recovery we've seen, not just in the U.S. Economy, but the global economy as a whole. And at the end of the day, we really think it's naive to not expect inflation, to be a little elevated currently. And borrowing a phrase from Milton Friedman, inflation is always and everywhere a monetary phenomenon, at least in the short run. And I guess state it more simply, and not from an economist, which can sometimes be similar to what those predicting the weather at times. Inflation is normal and natural as long as it's stable. And so again, it's been definitely a challenging year, but one I think that we should all expect, and some of the effects lingering into this year. And so, in addition to this unprecedented fiscal boost, as we discussed before, we've definitely seen a significant shift in consumption take place from services to goods, where consumers have been snapping up more computers, electronics, appliances, furniture. As I think I mentioned earlier, we had a chair sitting off the coast of Los Angeles for quite a while, but and understandably, fewer hotels, airline trips, as we've had, certainly a lot of COVID-related concerns. And so, this obviously explains some of the large price increases that we've seen for goods like furniture, for example, and great deals to be had for travel and entertainment. And while we expect that trend to begin to reverse at the end of, and we saw that trend, begin to reverse a little bit towards the end of 2021, the U.S. economy in particular is still consuming more goods than we previously have as a result of the amount of stimulus that's been again injected into the system, as well as low interest rates. And it's really exacerbated a lot of these supply side shortages due to production and logistic bottlenecks. And so the story is really one of a temporary excessive demand combined with temporarily restricted supply. And there was an article in Bloomberg published in October that had a chart suggesting that our major ports were seeing about a 20 to 30% more goods go through it than pre-pandemic. Just to give you some perspective of the significant increase in the volume that we saw, undoubtedly shrinking the logistics chain, even without the labor shortages and some of the other demand-related pressures that we've seen. One of the other things, last quarter and the year in the quarter prior, is a lot of retailers, very worried about getting, inventory for the holiday season. And so we saw a lot of ordering. November 7th, I think, was the deadline back in 2022, ironically close to, I think, the election from, but nonetheless, we definitely have seen, people ordering more, businesses, obviously to make sure that they're meeting demand of consumers. And as a result, it's contributed to some of the more bottlenecks, especially related to the ports, more so than we would normally expect, just given the expectations of having a challenging holiday season. And so, I guess, in summary, we certainly think there's a zero probability that inflation expectations will, continue to be ingrained in the consumer, as well as business leader psychology. And ultimately, this could become a self-fulfilling force that in the long run will actually lead to deflationary pressures. And so, in other words, we expect consumers and businesses will eventually balk at higher prices, much like we saw with lumber prices, this time, or not this time last year, but about 6 months ago or so, with the expectation that they will normalize lower, presenting actually a headwind for growth. And so, the speed in which that occurs is certainly up for debate. But our base case is that we're very close, if not we've already seen peak inflation data here in the United States.
So let's take it a step further. We just had another reading last week from December, and it was fairly high. So walk me through how you and the team think about that series of recent inflation readings.
We just look at the headlines that are screaming inflation is not, at levels not seen since 1980s and call it a day. I'm obviously joking. There's a lot of fresh data that's been released recently, which has given us a really great glimpse into really what's driving this, inflation data. And I think it's so important to really look under the hood and understand what makes up, CPI, the Consumer Price Index, what makes up PCE. Maybe that's something you just want, our team to do, and us nerds who like to take a look at the basket of goods that make up these indices. But really, after with the November reading, we saw, as again the highlight, the headline suggests that CPI rose about 6.8% for the year, which was the highest 12-month increase since 1982. And unexpectedly, the December report showed CPI coming in at exactly 7% year over year, with core CPI, which strips out some of the volatile food and energy categories, 5.5%, which is still the highest in 2 decades. But again, looking under the hood, parsing through the data, the song continues to be the same in that the bulk of the strength in the underlying data primarily is driven by COVID-related supply chain issues, as I mentioned earlier. And that's a trend that gives us comfort that we will soon see inflation come off this peak and start to head south for the remainder of this year. And so just looking at a couple of categories, for example, apparel, we saw a substantial month-over-month increase of about 1.7%, but 90% of all apparel that we consume comes from abroad. And so obviously that has supply chain issues written all over it. Looking at transportation, which is also hot, up 2.13% for the month-over-month. Both used cars and trucks, demand related, new motor vehicles, parts and equipment, supply chain related. And so the data really is that noisy right now. And, headlines, stoking inflation. And we've, obviously have seen, so much concern from American consumers and our clients, about inflation. But it really doesn't simply capture the full reality of the situation that we're experiencing right now, nor the expectations of when things will, begin to moderate. So the last thing I mentioned, as far as, examples, shelter. So, where we all live has actually been not hot. In fact, it was quite the opposite, as I would imagine would be a surprise, to many. We actually haven't seen shelter prices, budge since September, and in the December report actually fell. And so, statistically, if we were to, try to, attempt to have 7% year-over-year inflation for the remainder of the year, we would literally need to see 6 straight months of month-over-month inflation prints of 50.5% or 50 basis points, to keep the annual rate at current level, which again we think is very low probability. And so, I think the big takeaway here is this is a one-time step up in prices, and a one-time step up in prices is not inflation. Inflation is a continued, persistent increase in prices, which is what I think the Federal Reserve has really been trying to say all along. And on the demand side of things, while we saw October retail sales actually be firm, November's retail sales were actually fairly weak, suggesting that Americans maybe started that holiday shopping earlier, as a lot of suppliers were attempting to get prepared for. And we saw retail sales actually fall about 2% in December, which was much worse than the forecast. And after excluding auto sales, fell over 2%. And so again, looking at the supply and demand dynamics of what's contributed to this inflation, we're seeing demand, begin to weaken a little bit. Part of that could certainly be as a result of, the COVID variant, putting more restrictions on, some of the hospitality and leisure sectors. But we also seeing consumer sentiment weaken as well, as many consumers are, afraid about inflation. And that, again, could be that self-fulfilling prophecy where people, tend to pull back their spending as they see higher prices move, prices move higher.